Good afternoon. This is Robert Rayburn here at Life Pro Asset Management. I hope that everyone had a great weekend. It is August 14th of 2023. And as you might have noticed at the pump there, gasoline prices continue to move higher. And that's going to really drive a huge part of the theme of this week's update, which is that continued reflation that we've continued to observe, not just across the US economy, but across the global economy. And we think that's the prime factor that's driving bond prices and interest rates and overall stock market allocations between value and growth stocks. So we are going to review all of that this week. And so I'm going to go ahead and share my screen here. The three big things that we want to focus on this week. Markets continue to work off an overbought condition. So we don't want to make too much of this or too little of it. Markets need to go down sometimes. We saw that last year. We saw that a couple of years ago. But even during bull markets, it's completely normal to have these 10% pullbacks, right? Even 5, 10, sometimes 15% pullbacks. And what I would say is that so far, this pullback has been relatively controlled. Would not surprise me to see some scary moments there with the overall market. But what we continue to believe is that this market pullback is more a function of leadership transition away from tech and into value, growth into value, those types of moves versus this cascading sell-off that just takes everything indiscriminately down with the ship. We don't think we're in that type of situation. We believe this is a generational leadership transition moment that is taking place. That gets us to number two, that difference between news narratives and price, this idea that we beat inflation. Well, maybe not so fast when we look at the bond market and we look at what interest rates are doing and we look at what commodity markets are doing. We don't pay attention to, well, we do pay attention to, we don't let the news headlines drive our decisions. We like to look at the price action, the symptoms of the market, because the market often prices things in ahead of the fundamentals coming into both price and into the headlines. Lastly, number three, that growth to value rotation is gaining momentum. We think it's going to accelerate. We don't think this is a 2 to 3 week or 1 month phenomenon. We want to position portfolios to prepare for that. So we'll go through all of that this week. So that market pullback, when we look at the chart here on the left, the percentage of stocks above the 20-day moving average continues to drop. We were somewhere in that 85% category. So when we look at 85% from a historical perspective, that's fairly overbought. Very normal to have these pullbacks. It's completely healthy. You're going to get that from time to time. But what we also like to pay attention to is the overall symptoms of the pullback. What's working during the pullback? What's not working? Is it a credit-driven pullback that could lead to something worse? The good news is you're seeing credit markets actually act pretty well, which is also surprising because interest rates are breaking out to the upside. And usually when rates move to the upside, you do get some pressure in the credit markets because the cost of capital is moving up. I haven't seen that so far. So that's really, really good. The other thing we would notice is that, or we would point to, is that utilities are the worst performing sector so far throughout this pullback. A function of higher rates, right? Because utilities have no real revenue or earnings growth. They're really a function of that high dividend yield. So when rates move up, that real yield gets compressed on the dividend yield. The other thing we would point out to, technology, semiconductors, those types of areas, artificial intelligence stocks, they're all dramatically underperforming. Remember, we've been beating the drum on this for the last couple of months. Overpriced, in a bubble, call it what you want. We think that sector and those types of stocks are dangerously priced. We continue to believe that. And we look at the one sector that is dramatically outperforming, it's energy, right? So when we look at the percentage of issues above that 20-day moving average, energy stands out as that one sector that's not defensive. It's actually cyclically and economically driven, and it's going up in a down tape. We think that's an indication of that market transition away from secular growth and into secular value. So what happened to deflation, right? We so-called won that war against inflation a month ago with the CPI report, right? Inflation went at 3%, reiterated that this week at the new CPI report, again at 3%. But the bond market is ignoring it. Rates are moving up. So this chart here on the left, this is the US 10-year interest rate swinging back to the upside. And actually, this is the chart as of Thursday of last week. If we update this chart, we're north of 4.1%. This is a significant breakout. We see here rally, consolidation, and now breaking out through that consolidation. Not only that, we're seeing that response reiterated across the global bond market. The UK market right here, the German bond market, the Canadian bond market, the Australian bond market. We're seeing it across the board. Japan as well. Rates breaking out to the upside, not just in the US, but across global bond markets. So the question really is why? I thought we defeated inflation. Well, remember what we talked about. The CPI report is a backward-looking index, looks at a month ago. The market's a forward-looking mechanism. So it looks for those real-time indicators. And what better real-time indicator for inflation and what we pay out of our pocket, and whether that's going up or down, whether we're taking more or less dollars out of our pocket to pay for something, than commodities. Oil up 25%. Gasoline prices up 24%. Natural gas up 30%. Copper up 5%. All of this is a function of what's been taking place in the commodities market and the supply-demand picture in the overall economy. Notional demand is up, notional supply is down. Rates are a reflection of that reflationary environment. Hence, hence the rotation that has started to happen in the market. Chart here on the left, relative strength charts, the relative strength of growth stocks relative to the S&P 500 peaked in June and it started to decline. Same with value, bottomed in June, July, and it swung to the upside. Why is that? Because of that rate rotation that we've seen, right? As interest rates move up, people prefer cheaper stocks with good free cash flow growth that they're going to realize their earnings today versus those expensive growth stocks where most of the growth is going to take place in the future. Hence, when rates move up, it discounts the power of those future earnings. So we want to be very wary here. If rates are truly breaking out for another powerful move to the upside, we think this is going to reignite the second inning of that value rotation trade that started last year. We think this is inning number 2 of a 9-inning game, and energy is the leader of the pack. To also kind of put this in comparison what's happened this year, the highest yielding stocks in the S&P 500 are down 3.2%, and the 100 non-yielding stocks in the S&P 500 are up 21%. We think this reverts. We don't think this is a sustainable rift between the two parts of the market. A lot of these yielding stocks that have great dividends are great companies with great free cash flow growth, and in many cases are performing from a fundamental point of view far better than the companies that don't have any dividends attached to them. So this is the dispersion that we see will revert back to the mean. And we do think energy is going to lead that pack there. So when we look at this chart here on the left, the percentage of stocks above the 200-day moving average, close to 100%. The percentage of stocks that are above the 50-day moving average, just over 80%. This reminds us a lot of 2022 and that great rotation that we saw. We think we're there again. And we look short term, this is technology relative to energy. Remember we talked about that peak in May and June? This has been the rotation out of tech and into energy. Again, this is the beginning. We believe this marks the beginning of inning number 2 of that great rotation away from the secular tech bull market and into this budding or emerging secular bull market for energy and commodities, base metals such as copper, etc. We see the same thing. Consumer discretionary was largely in that 12-year bull market with tech, that rotation into commodities, right? You're spending more on energy, you're probably spending less on consumer goods. Putting it into a long-term picture, this was energy relative to technology, this cascading low and that powerful tech, innovation-driven bull market of the 2010s and into 2020 and 21 starts to reverse, right? And then we get this big rotation right here in 2022. And then we get a test. Okay, is this real? Or is this just a head fake again for energy, right? This is what we call a classic pullback within an emerging breakout, right? So strong breakout, a pullback to the breakout point. And guess what? We're starting to break back out. We think we go well beyond this peak. This is the emergence, again, of inning number 2. Long-term, 120 years out, this is commodities versus the Dow Jones. Again, that huge secular low. We think this is one of the most attractive areas for investment right now. Commodities have been underinvested for the better part of 12 years. Demand has continued to increase. It takes years to permit, develop, build, open, and finally get an open pit or underground mine into production. Oil wells, slightly shorter time frame, talking anywhere from 2 to 5 years. But if it's a new oil field, it can take much longer. So the supply response to rising demand is going to take years. And that gap is going to cause, we believe, a big price acceleration to the upside. So what are the areas that we are focused on? Global energy, metals and mining, banks increasingly. We haven't done a huge amount of bank stock purchases yet, but those banks continue to look attractive, especially with the negativity after March, and consumer companies with pricing power in a stagflationary environment. Combine that on the valuation side, cheap valuations. These are just companies with incredibly cheap valuations. They're free cash flow rich, and they're underowned and much maligned across most of Wall Street. So bottom line here is, as interest rates continue to break out, we do believe that secular rotation out of tech and into energy will reassert itself. So 3 big takeaways from this week. Stock market continues to work off that overbought condition within a leadership transition away from growth and into value, which is our third point. And right there in the middle is we think that the breakout in global interest rates is sparking that move from growth into value. So that's what we got for you this week. 888-543-3776 is our number. Please feel free to reach out to your advisor. Other than that, have a great week. We look forward to hearing from you and talk to you soon. Thank you again.